If you've ever bought anything in India, you've probably stared at the receipt and seen a puzzle of acronyms, CGST, SGST, IGST. It can feel like you're trying to crack a secret code, right? Well, in this explainer, that's exactly what we're going to do. Let's dive in.
I mean, we've all been there. You see the price of the item, you see the final total, and smashed in between are these three-letter tax codes. Are they three different taxes, or is it one tax with three different names? That's the exact question we're going to answer. Stick with me, and by the end of this, you'll be able to read any Indian receipt like an expert.
So here's our game plan for cracking this code. First, we'll start with the receipt itself. Then we'll uncover the two simple journeys a product can take that basically change everything. We'll follow the money on a local transaction and then a cross-country sale, see how it all works in a real supply chain, and wrap it all up with a final cheat sheet. Let's get started.
Okay, so let's set the scene here. India has this big unified tax system called the Goods and Services Tax, or GST. But, and this is the big question, if it's supposed to be one tax, why on earth do we see three different names on our bills? That's the central mystery we're about to solve.
Well, here's the secret, and it's actually way simpler than you'd think. It has nothing to do with what you're buying. It's all about where. The entire system, all those acronyms, it all comes down to one simple thing: the location of the seller and the location of the buyer. That's it. That one detail determines everything else.
So the whole thing really boils down to two simple journeys a sale can take. First, if you buy something from a shop in your own state, you live in Delhi and you buy from a store in Delhi, that's what they call an intrastate transaction. But if you order something from a seller in a different state, let's say you're in Jaipur ordering from a company in Delhi, that is an intrastate transaction. This simple difference, that's literally the key to the entire puzzle.
All right, so let's talk about that local intrastate sale. When a transaction happens within a single state, the government splits the tax revenue. So if the total GST rate is, say, 18%, half of it, 9%, goes to the central government as CGST. The other half, the other 9%, goes to the state government as SGST. It's still one tax, the GST. It's just collected in two buckets to be shared.
Now, the moment a product crosses a state line, everything changes. To stop all the confusion about which state gets the tax money, they just simplify. The whole GST amount gets collected as one single tax, IGST, which stands for Integrated GST. The central government collects all of it and then makes sure the destination state gets its proper share later on. So an 18% GST just becomes a single 18% IGST charge. Simple as that.
All right, enough with the theory. Let's see how this works with some actual numbers. We'll start with a straightforward purchase made entirely within the city of Delhi. Okay, let's walk through this together. The price tag on the item is 12,000 rupees. Nice. The store gives you a 30% discount, which is 3,600 rupees off. So the price you actually pay before tax, that's the taxable amount, is 8,400 rupees. Now the GST on this is 18%. And since this whole sale is happening inside Delhi, that 18% gets split right down the middle. 9% for the central government, CGST, which is 756 rupees, and another 9% for the state government, SGST, another 756 rupees. You add it all up, and your final bill is 9,912 rupees.
And here it is, laid out perfectly. You've got your selling price, 8,400. Then the tax is split beautifully between CGST and SGST. And look, IGST is 0. This is the classic signature of a local bill.
Okay, now for part 2. Let's take that same idea and see what happens when we go cross-country. We're following a sale from a seller in Delhi to a buyer in Jaipur, and you'll see how the math completely flips.
All right, a bit of a bigger purchase this time. The MRP is 50,000 rupees, and there's a 20% discount. That brings our taxable selling price down to 40,000 rupees. The GST here is 28%, but remember, this is an interstate sale. It's crossing a border, so we don't split it. Nope, the entire 28% is charged as IGST, which comes out to 11,200 rupees. Add it all up, and your final bill is a nice, clean 51,200 rupees.
And just look at the difference on this bill. Selling price, 40,000. But now, CGST is 0. SGST is 0. The whole tax is parked under one heading, IGST. See? The total amount of tax collected is based on the same principle, but how it's collected, totally different.
Okay, so far, we've only been looking at the final sale. from the shop to you, the customer. But what about the journey a product takes before it even gets to the shelf? Let's zoom out a bit and follow the tax trail through a real supply chain.
So here's the story. We've got a product that first moves inside one state, from Agra to Kanpur, which are both in Uttar Pradesh. Then it crosses a border, going from that dealer in Kanpur to a customer in Jaipur, Rajasthan.
So the journey kicks off in Agra. A dealer there sells goods for 20,000 rupees to another dealer in Kanpur. That's an intrastate sale, right? Same state. Then the Kanpur dealer adds a little profit, say 5,000 rupees, and sells the goods for 25,000 to the final customer over in Jaipur. And that's an interstate sale.
Okay, now this is where the magic of the GST system really shines. It's this concept called input tax credit. Just focus on the dealer in Kanpur for a second. When they bought the goods from Agra, they paid tax on it, right? 3,600 rupees. That's their input tax. Then, when they sold the goods to the customer in Jaipur, they collected $4,500 in tax. That's their output tax. Now here's the cool part. They don't just send that whole $4,500 to the government. No way. The system lets them get a credit for the tax they already paid. So they just subtract their input tax from their output tax. 4,500 minus 3,600, which is 900 rupees. That 900 rupees is the tax on the value they added, that 5,000 rupee profit. This is huge. It prevents a tax on a tax, and it's really the beating heart of the whole GST system.
Whew, okay. We've gone from a simple receipt all the way through a supply chain. Let's boil everything we've learned down into a quick and easy cheat sheet you can remember.
All right, here are the 4 golden rules to remember. Rule number 1. If a sale happens inside one state, the tax is split into CGST plus SGST. Rule 2. If that sale crosses a state line, it's one single tax, IGST. Rule 3. The total tax rate, whether it's 18% or 28%, doesn't actually change, just what we call it on the bill. And finally, Rule 4. The big one. Businesses get credit for the tax they've already paid. They only pay tax on the value they add. And that's it. That's the engine of the whole system.
So, the next time you look at a bill, you're not just going to see numbers. You'll see the story, right? You'll know the journey that thing you bought actually took. But let's think even bigger for a second. We just saw how the system makes sure businesses only pay tax on the value they add. Now imagine having a system like that for an entire country, a system that tracks value so perfectly